All right, everyone, and welcome to the November edition of the Secret Weapon Chats series. Thank you very much for coming. Today, we're going to be talking about your exit strategy and how that might have changed in the uncertainties of 2020 and 2021 to come. The first thing to do is to introduce ourselves. So some of you who are regulars on this series or our previous series might know me. I'm your host today, and I'm Ian Rogers. I'm the founder of Entreflow Consulting Group. I'm an MBA, father of two businesses too, I suppose you could say, and really enjoy working in the entrepreneurship and startup high growth companies kind of community, and love doing these things. And I'm very pleased as well to welcome Axel Christensen on this call, an expert in mergers and acquisitions. And Axel, can you say a few words to introduce yourself?
Yeah, sure. Yeah, and thank you for having me on today. So Axel Christensen, academic background, I'm MBA, CFA. Just started the Chartered Business Valuation program. Been working in corporate finance and mergers and acquisitions for 25 plus years. A number of years in the sub-debt mezz space where I was structuring and funding M&A transactions, and for the last 5 years with Renaissance Mergers and Acquisitions, where we're providing advisory support to small to mid-market companies that are looking to transact, either buy or sell companies.
Sounds good. I'll introduce Entreflow for those of you who haven't heard of us. We're a boutique firm. We're about 25 people based in Vancouver. And we do this kind of thing where we help small and fast growing companies to achieve their goals. And we do that through a few types of services, mostly in the back office. So we're really working for management and helping with CFO services, accounting. So we're a licensed CPA firm, so we can do taxes. Also on HR, so helping with hiring and recruiting, HR planning, and all the fundamentals that really make a well-run business. And some of that also involves a lot of systems work to make sure that things are connected well together. A little bit about Renaissance. You want to go through this, Axel?
Yeah, sure. As I touched on, we're an M&A advisory firm. So we help entrepreneurs who own small to mid-market companies either buy or sell. We define a small to mid-market as companies that are generally in revenue range of 5 to 50 million. We'll sometimes dip down smaller than that. Sometimes we're dealing with larger companies than that. We were really created to fill what we saw as a vacuum in the industry where, particularly for transactions under 25 million, there just wasn't a lot of really qualified expertise available to support that size of business. And so our strategy was to build a team of folks with all the right academic pedigree that you would want to see in a professional M&A advisory firm, but also folks that have decades of transaction experience. And so the idea was if we gave the same caliber of advice to smaller companies as the bigger guys are getting from the KPMGs and the Deloittes of the world, what would happen? And surprisingly, we've been able to engineer some very nice outcomes for our clients, and that's obviously served us well as well.
Oh, that's really great. So it really feels like we're working with the same kinds of companies, just in different ways. And if we do our jobs really well, then we're going to set things up for a nice transaction for you and your team.
Oh, it's incredibly complementary, and we'll talk about some of the things that people need to be considering pre-sale. And most of those are services that you provide, and those are things that it's often difficult for the entrepreneur to be executing on independently on their own as they're trying to do all the other different things around their business. So it's hand in glove. Yeah.
Sounds good. Well, let's get into it. We put a few, if you signed up for the event, you would have seen these bullet points on the event description, so they should be no surprise. Really like to start looking at the trends, sort of what's been happening in mergers and acquisitions and transactions in 2020, and then get out our crystal ball, I suppose, Axel, and see what we can predict about what's going to happen in 2021 and beyond. I think we see some trends that are emerging, and we can make some inferences based on those. And then we'll get into what you can do now, what you can take action on to set yourself up for a successful exit and a successful due diligence process. So before we get into that, I want to invite you to check out the series of chats. So this is part of a series. Some of you went to our website and signed up already on that, which is great. Some of you found the individual event page and just signed up through the Zoom registration, and that's great too. If you didn't sign up for the series, go check out our website. It's entreflow.com. And you can easily find under secret weapons, you'll find events, and you can click through and find the event page that looks a bit like this. And then for future events that come up like this, you'll get notifications so you can sign up for those things. Okay. I will put this URL in the chat later on. So if you miss it here, don't worry about it. I'll put it in the chat for you guys later on. The next thing before we get deeper into the meat of things here is that we'd really love this to be an interactive session for all of our events. We love questions as we go. So Zoom allows us to do that in a few ways. Please, in the chat, you can set the chat to all panelists and attendees. So type in a question or comment there, and we'll usually address it. You can also raise your hand or put a question in the Q&A box. For certain questions, we'll even invite people to come on mic and speak directly to us or the panelists. So you're encouraged to participate. We love questions. Okay. At this point, I'll turn it over to you, Axel, and you can take us through some of the current trends that you're seeing.
Perfect. Okay, excellent. So I'll start kind of laying the framework of what the environment was like pre-COVID, and then talk about some of the changes that COVID has brought to bear on the market. So I say broadly, pre-COVID, the M&A market was very robust, definitely a seller's market, lots of transactions happening. And that was because the key ingredients for a really active M&A market were overlaying very nicely. And they don't typically overlay as nicely as they have been for the last few years. Historically. So the first ingredient is capital availability. And so when you're talking about capital, you're talking about debt and private equity for the most part. And debt has basically as cheap as it's ever been. Even post-COVID, it continues to be that way. And so when somebody can walk into a bank and raise copious amounts of debt on very favorable terms at high leverage multiples, with government bite and all the rest of the stuff, that allows people to pay up for whatever asset they're considering purchasing. So that could be Vancouver real estate, your company, whatever it is. This buoyant sort of lending environment creates upward pressure on asset values across the board. And so we were certainly seeing that pre-COVID in spades. And there was a bit of a pause, obviously, around COVID, but we're certainly seeing capital starting to flood back into the market again. There's just so much out there that you're not going to hold it at bay for very long. And the banks need to generate profit for their shareholders. And so that is already starting to resume in earnest. So next slide, Ian. And so I touched on private equity. This is the amount of what they call dry powder available. So the capital that's been raised but not yet deployed. It's at or near record levels. And so pre-COVID, whenever we had a private equity group on the other side of the table, we knew that there was meaningful urgency for these folks to get a transaction done and get a deal out the door. That has not changed post-COVID. There's still copious amounts of private equity out there. And one of the fastest sources of capital or buyers coming back to the table post-COVID were the private equity guys. They paused, as everybody else did, for a period of time as they were dealing with fires in their existing portfolio and just trying to get a handle on where this whole COVID thing was going and how the economy was going to play out. But that for many took a couple of months, and then they were right back at it, calling, looking for new deals. And so they're very actively back in the market again. But again, lots of capital availability, all speaks to pushing up values for companies that are being sold. Okay. And so what we had was a pretty steady and robust valuation environment prior to COVID. This is for fairly large companies. That's what's considered a relatively small company by US stats, but 100 million and under. I'd say if you looked at smaller companies, 50 million and under, 5, 6, 7 years ago, you're probably looking at a range of somewhere between 3 and 5 times EBITDA for a vast majority of companies. There's always outliers. That had pushed up to 4 to 6, maybe even 4 to 7 pre-COVID. So we were seeing transactions, oftentimes in that 5 to 7 range, and sometimes outliers larger than that, depending on the circumstance. If it was a SaaS company or a nice recurring revenue business of some description, getting very attractive higher multiples. Next slide.
This was my injection of a question was, how has COVID changed valuations, or I should say the way that valuations are done, or the things that people are thinking of?
Yeah, it's definitely complicated valuations because first off, who knows how COVID plays out in the long run, and you get so many different perspectives. We have a lot of companies we talk to that are benefiting significantly from COVID, and their view this is a long-term shift that's never going to change. Companies that are not doing so well as a result of COVID are clearly viewing this as a short-term headache to deal with, and we're going to be back to normal in a short period of time. So clearly both those scenarios are not likely to play out. It's going to be one, both, or something in the middle, and probably something in the middle. And so that's how our valuation process has morphed as well. So pre-COVID, you could probably look at one potential forecast and give a range plus or minus 10% in terms of values based on that anticipated future cash flow the company is going to generate. In COVID, you've got to look at multiple scenarios. There's a worst case scenario, there's a best case scenario, and something in between, maybe sometimes even more scenarios than that. And then you're pinning a value based on some weighting of what you think those different outcomes are going to look like. So it's made valuation more complicated and more difficult, I think, probably to be accurate going forward with valuation over the near term anyway. For
sure. Are they still looking at the same multiples, EBITDA multiples and things like that, or are they starting to base valuations off different sorts of metrics?
That really varies, because one thing that's become very clear is the winners and losers in this COVID environment. As I touched on, we've come across a number of companies that are doing extraordinarily well. If you're in the right tech space, a lot of those companies are doing really well. Food distribution business that's going through the grocery channel, doing very well. There's a number of segments that are up significantly. Those companies can fully expect to get pre-COVID multiples and maybe even a little bit better, because you've got all this money now coming back looking for a home, and you've got a relatively smaller environment of sellers, because there's a bunch of folks that aren't doing well and probably aren't contemplating selling, or it might not be saleable at a value that people are happy with. So there's a smaller pool for the funds to look at. And so when you've got something that's outperforming, there's a disproportionate number of buyers focusing on that. And so that will allow you to get pre-COVID multiples, but maybe even a little bit better if you're really attractive.
Sure.
On the flip side, there's a lot of companies that are, some are mortally wounded and others are some degree of that. And so you're clearly going to see a lower multiple for that fact pattern in this environment.
Fair enough. A couple questions on the line here. The data you had for the equity dry powder data was pre-COVID. Any idea where it's trended in the last year?
Yeah, that doesn't change quickly. Like, it takes a while to raise a fund, and if anything, that's increased because there would have been a whole bunch of fundraisers in process, and some of those might have stopped as a result of COVID, but I think a lot of them that were kind of the later stages probably just carried on. May have had some renegotiating terms on the fund. So that's not something that's going to change quickly. So that, I think that benefit to sellers will persist for a period of time.
Sounds good. Thank you, Philip, for that question. William asked, are deals taking a long or short time to close? I suppose, how has that changed?
Definitely taking longer. Partially the buyers in a little bit better negotiating position, so they can demand a longer diligence period. Secondary, it's hard to kind of refute that a longer diligence period is probably appropriate in this environment. For example, if you're buying a company, you could probably assume that the company's suppliers and customers are going to be solvent over the longer term. In a COVID environment, that's not necessarily a safe assumption, and so that next layer of diligence needs to be done, and that takes a little bit extra time. For companies that are doing extremely well, we're still in a good negotiating position, and you can kind of force the terms and keep it to a little bit tighter diligence period. But broadly, deals are taking longer. Cool. Yeah, so this is another factor that was really driving the market pre-COVID. A lot of the sellers are baby boomers, and so there's this glut of folks that are now hitting the age of 60, 65, and are coming to the time where they need to consider, what am I going to do with my company? And we were in a situation where they were early on, like a lot of these folks are holding their companies a lot longer than anybody anticipated. Everybody thought this shift was going to happen 10 years ago. Absolutely nothing happened until probably about 2 years ago. It seems like 70 is the magic number when people really get serious about transacting their companies, unless you're in the tech space or what have you. And so that was just starting to kick up. So we had all this demand, all this money chasing deals, and people not selling at the pace that people were anticipating. And so that supply and demand imbalance was putting upward pressure on values, because again, all this capital had been raised in anticipation of this demographic shift, which took much longer to actually start happening, and then has been paused as a result of COVID right now.
Mm-hmm. And so for our, let's say, young tech companies, that they have to consider this in terms of competition for those funds, right?
To some extent, but I would suggest that the funds that have been raised to chase this boomer opportunity are very different funds from the ones that would be investing in earlier stage tech companies. And so, yes, so the high level, there's only so much capital out there, and it's going to go to one fund or another. But once it's committed to a fund, it's not as though one of these later stage private equity groups is going to be investing in a venture staged company if they don't do this baby boomer deal. So
gotcha.
I don't know. It's as direct competition as you might think. Yeah.
Fair enough. All right. COVID impacts.
Yeah, so now COVID hits, and obviously jobless rate through the ceiling. We've had a nice bounce back, but I was just on another economic call earlier, and it was showing that something like 30% of companies in BC have recovered to their pre-COVID revenue levels, but everybody else is down, and many quite markedly down. So we're far from being out of the woods here. The banks all had their GDP estimates, and they're horrific for the coming year, and hoping for a bounce back next year. There was an immediate shutdown on bank lending, and that starves off the M&A market. If the capital is not flowing, then M&A is not going anywhere. And so there's a period of time where the bankers were paused and just trying to get a lay of the land and seeing how bad this was going to be. As I touched on earlier, that's bouncing back very quickly. Still a little bit more difficult to raise capital on the same leverage and terms as pre-COVID, but if you look hard enough and look at enough sources, you're generally getting close. And M&A was hammered. I mean, there's no other way to put it. There was 2 months there where literally the phone did not ring. There was nothing for me to be doing. Everybody was dealing with fires in their firm. The buyers were dealing with fires. The private equity guys were dealing with fires in their portfolio. And so really nobody was thinking about buying or selling anything at that point in time. Q2 of last year, M&A was down 78%. So I would suggest that the only deals that were actually getting done were ones that were very close to the finish line. So they just pushed them across and got them done. Q3 of this year, M&A is down 45% over last year. So still well down, but a clear favorable trend. If you call 45% down favorable, it's, if you're hitting yourself with a hammer, you're hitting yourself a little more softly now. So, but it is definitely clearly getting much more busy. Like we're having a lot more conversations with sellers that are keen to do something in this environment. So, and the capital and the buyers are clearly there. So I don't think it's long before we start to see something that feels more normal. And this is just graphically showing the pitiful drop in M&A activity over the second quarter there.
Yeah, well, we won't keep that on the screen too long.
No, that hurts to look at.
That's a bit painful, I'm sure. So yeah. we'll move on to the future, the outlook here. Indeed. Okay. So crystal ball's out.
Yeah, so I'll emphasize the crystal ball, and who really knows what's going to happen here. But what we do know is there's lots of capital out there that's not changed. The banks still need to lend money, and they're showing an appetite to do that. There's tons of equity capital out there. So that would suggest that the market's going to reset sooner rather than later. And I think we're already seeing some good signs of that. Depending on how the company is performing, there's going to be a value reset. Like the purchasers that were immediately out to the market after COVID were clearly bottom feeding. They were looking for deals that were a little bit wounded and they wanted a significant discount. That is morphing into folks that are recognizing that a lot of companies are going to trade for pre-COVID multiples based on their performance. But I think overall, you're going to see a lowering of multiples on average. You're going to see a number of companies in there at similar or higher multiples, but there's going to be a broad group of companies that are performing less well than they did previously that are going to trade at lower multiples over the medium term. We're going to see a lot more deal structuring. Pre-COVID, a lot of our transactions were all cash, or maybe a very small vendor note or a very small earnout component. But the sellers were clearly in the driver's seat from a negotiating perspective. And so the terms reflected that. Buyers are now have a better negotiating position, and there's clearly more risk, and sellers clearly cannot point with as much enthusiasm as to what the forecast is going to look like. And so that just speaks to those trailing considerations being earnouts or something performance linked more so than historically. And so an earnout is really just a structure where some of your value is paid in cash, but the rest of it is paid based on how the company fares going forward. And so we're definitely seeing much more of that already in the near term. Touched on it, companies that are outperforming or just have proven to be stable should do well going forward from a value perspective. The rationale is, okay, I was a good company before. I've proven I can survive hell and damnation, which has rained down upon us for the last 6 to 8 months. So you've got to be even more comfortable about my future cash flow based on that track record. And that's absolutely true. What we're counseling people is, now don't be greedy, because we have seen some clients whose value expectation has gone meteoric as a result of that experience, and the market is just not going to keep up to those expectations. We're seeing a US dollar, Canadian dollar. Well, earlier on, it's starting to shift a little bit now, but we had early interest from a number of US buyers because they recognized the Canadian dollar was quite weak. And so they thought, okay, we can buy a Canadian company with a currency tailwind, we'll grow the business and then we'll sell it, and there'll be a currency benefit as well. So with the Canadian dollar coming up a little bit, that's eroding somewhat, but I think that likely will be there in the medium term. We know the sellers, this doesn't speak so much to the earlier stage tech companies, but the boomers are still there and they still got to transact. There's nothing going to change the fact that they're getting older. And if anything, this whole COVID experience has kind of reaffirmed their mortality for a lot of folks. We're having a lot of conversations with folks that said, I'm ready to go. Somebody that they know has passed away as a result of COVID, or just the overall overarching fear that COVID has created for people, particularly in the older age bracket, has caused them to say, there's more to life than running a business, and maybe it's time. So for many, it's accelerating the program. Now it's a question of, are they ready to actually transact? And over the medium term, I think, it'll be a little bit more of a buyer's market than it was pre-COVID. But my expectation is that's going to change fairly quickly. You're probably looking at 6 to 12 months where it's like that. And of course, all of this is, predicated on the assumption that we're going to have vaccines and things are going to start to get better. If that proves to be unsafe, then all bets are off, and it'll be probably quite different.
Well, let's just hold that assumption in mind, and some of the pundits are saying, well, based on rates of vaccine production and all that kind of stuff, that we're probably going to be in this for another year or so, and so holding that in mind, as we get towards the end of that, 2021, do the markets anticipate that? Are we feeling like, okay, if we're looking for an exit in 2021 or 2022, late 2021, I should say, or 2022, then we can feel like things might be getting back to normal, or they're fundamental shifts that won't go back after we get out of this this pandemic situation. What are your thoughts there?
Yeah, I mean, my expectations will return to normal, and for the companies that get through, it might actually be a better economic environment, because there'll be a lot of there are unfortunately a lot of companies that aren't going to make it through this, and so for the ones that are there, you're going to have, I think, returning demand. Like you look at the travel industry and all that kind of thing. I think there's going to be lots of pent up demand for people to travel again, myself included. And there are going to be significantly fewer players. And so the ones that are around are going to benefit from a resurgent market with less competition. So I think for a number of players, it's going to be a very healthy market going forward. So I don't know that there's going to be my view is there's not going to be a lot of permanent changes. I mean, it's accelerated some shifts. It's accelerated the shift to online. It's accelerated the embracing tech and accelerated working from home. And I think there's going to be certainly positive lingering effects of that. But the broader economy, I think, will get back to something largely normal after this.
Very good.
And then in terms of, sorry, just to add to that too. So in terms of how much runway you need to show a potential seller, ordinarily we tell people, look, you need to see at least a year, better two, of good performance before you sell. In the COVID environment, I don't think that you're going to need to show quite that much because COVID is clearly a very defined event. And so I think once we're through it and it's clear that we've got COVID dealt with and the economy is improving, if you can show that your company is improving and there's a clear, you can show some visibility to future earnings, maybe a good order pipe and that kind of thing, I think we'll be able to normalize the COVID impact with a lot less future performance than normally we would need, which would be positive for sellers.
Very good. Okay, I already asked this question, so I'm just going to skip over the slide, and we can talk about the how to prepare, which to me is the fun part, because these are the things that you can actually take action on. All the rest of the stuff is external to the organization. So and I flipped the order on this, on the Axel, but I really just wanted to highlight, at least for me, when I'm thinking about exit, I really start to look at, well, who could buy this company, and how do I think about that? So you've got the three categories: exiting to another individual, exiting to a private equity firm, or strategic buyer. So essentially strategic, the way I define it is that somebody who is in your market or a tangential market who could add your solution to their portfolio, and earn some synergies from doing that. And so the benefits to both sides are higher, and so the deal values are generally a little bit better in that case. So that's the way I think of it, and it helps to keep that sort of thing in mind when you're preparing for an exit, at least for me. Any other comment on that?
Yeah, no, I would agree entirely. You want to keep your audience in mind when you're preparing for an exit. This slide was really created. We use this to show people the value of running a competitive process and why it's important to do so. And we typically reach out to several different purchaser categories, strategic, private equity, and individuals with smaller engagement. And we do that because you never really know who's going to bite, and so you want to hedge your bet. But you're absolutely right. The strategics generally should be the most promising purchasers because of the consolidation savings and the strategic synergies that many of them have. In the software space, you'll see security software companies sell for billions of dollars. It's not selling for that because it's generating cash flow to validate that value. It's selling for that because the much larger acquirer has the channels and what have you to leverage that technology and generate that type of cash flow. And so strategics typically should be the ones that can pay the most for a business. In the environment where there's been so much private equity overhang, we've seen private equity groups compete on value with strategics in a lot of circumstances, which intuitively maybe doesn't make sense, but it's maybe a function of the cash that they have, and it's also a function of the fact that they might have investments in their portfolio which would render them a strategic purchaser, even though they aren't. a private equity group.
Yeah.
And just the point of this slide is this is a recent engagement. We went out to 90 potential purchasers. We got 7 offers, so a healthy response. But even within those 7 offers, after fully negotiating, there was massive range in terms of the value people were willing to pay, and there was massive range in terms of the quality of the terms and conditions they were willing to offer. And so the point we make to people is, don't engage with the one group that reaches out to you and flatters you and says, we've been watching you and you look like a really terrific business, we'd like to buy you. The likelihood of the whole universe of buyers out there that these are the absolute best who are going to pay the best terms and the greatest price is pretty close to nothing. It's not until you get a competitive process going that you're going to flesh out who's out there and really flesh out what they're willing to pay.
Mm-hmm. And this is one thing that I often tell companies that aren't planning for an exit in the next year or two, but know that they would like to someday, is just you start talking to people sooner than later. The advantage of a strategic exit is if you're in the industry, you already know who these organizations are, and potentially you can already do some networking to identify, maybe they have a corporate development group and that might be looking at deals and stuff. And if you can get to know the right people, then you can get to know what's important for them and at least be on their radar and add them to the mix when you are ready to be in a process, and that will help things along.
Absolutely. And one of the things that purchasers value the most is predictability and ability to execute. And so if you reach out to them early and you kind of talk about the milestones you're looking for and you hit those, you are getting well more valuable in their minds right away, because that differentiates you from probably 80 to 90% of the other companies out there. So, and if you can develop a strategic relationship with a strategic acquirer where they're now becoming dependent on you because of that relationship, you're really increasing the value of that individual buyer as well.
For sure. Okay, we'll get into your top 5 here. And there's a couple of questions queued up, but let's deal with the top 5, and then we'll come back for a couple of questions.
Okay. Perfect. Yeah. So I would say the things that make for a good, healthy company that's likely to be sold for a nice value, and the pre-sale work you do hasn't changed a lot pre-COVID, post-COVID. I think there's a COVID overlay that you would do to this, and that you want to be explaining to people what your COVID experience was and how you managed it. And again, if you were able to show that you were able to pivot and manage and get through, I think you become a more valuable company at the end of that, because you've been battle tested. Having been in corporate finance for many, many years and been through a few recessions, there was always companies that looked like rockstar companies were doing really great, growing. Recession came along, they had no ability to adjust and went down like a bag of hammers. So the company that has shown itself to be resilient and have the grit to get through something like this is a company that lenders want to lend to, buyers want to buy. And so you want to tell that story over and overlay it some of the points that I'm going to make here. So first one, and this might be a little less relevant for an earlier stage technology seller, but certainly for all the baby boomers that are selling, this is enemy number 1. If you've been building a company for 30, 40 years and you think that you're going to extract yourself from that with no emotional blowback, that simply is not going to happen. And the behavior that comes with the emotional lack of preparation is bizarre at times and can really kibosh transactions. And so our recommendation is that you need to paint a very clear, not our recommendation, this is what experts who are much better at this kind of EQ stuff than us finance types are. But those experts say what you need to do to make that transition as smooth as possible is a very clear view of what you're moving towards. And so are you going to be on some boards? I mean, golf and the grandkids is not going to cut it. That clearly is not fulfilling enough over the long term. So it's got to be something else that gets your mojo going. So you need to paint a very clear picture of what that's going to look like. To start a smaller business, side hobbies, you're on significant boards where you're still contributing, all that kind of stuff. Failing to do that, I mean, we see people demanding ridiculous changes to deal terms at the 11th hour. Is kind of how this manifests itself. Trying to unconsciously sabotage the transaction because they're afraid of what comes next, because there's no planning. It's just a black box of emptiness. I was on a call earlier today as well, and they were talking to some entrepreneurs about their experience, and one fellow said, I don't want to be sitting playing cards in a Tim Hortons with a bunch of old guys. And so, yes, if that's what you're planning, I would not stop working either. But there are other options. And so the key is to kind of flesh out and really paint a clear picture of what those are. Okay, and so some of the other buckets, and this is not in order by any means, but buyers are looking to acquire your people. Oftentimes that is the greatest asset that you are selling. And so you want to be constantly looking to high grade your team. COVID has actually been helpful in that regard because every business has underperformers, and as you've probably culled off the bottom, and as you've ramped back up again, you hopefully have been able to replace those people with even better performers, and so your team has gotten stronger through this. And you also want to start positioning the company so that you are not chief chef and bottle washer. And so you do not hold all the client relationships. You're not making all of the strategic decisions. You've got that next level that is able to run the company for extended periods in your absence. It's not the end of things if you are still fairly significant in the operations, but it just means that you're probably going to have to be comfortable sticking around for a longer transition period after the sale of business to transfer that intellectual property from your head to the new owners. Great to have great people, but you need to have them locked in. So make sure you've got employment contracts and have them appropriately remunerated so that they want to stick around long term. A lot of times in transactions, you'll see the buyers want to incent the key people to stick around with maybe an ownership position or some sort of incentive to keep them on. Operations, you want to give the illusion of perfection, even though that's never the case. So, for a manufacturing business, you want it to be a nice, clean shop. You don't want it to be black and filthy and all the rest of it. You just want to show that you're on top of the small details. Because if you're not on top of the small details, then people start to wonder, if I pull at this thread, what else is not great about this business? And so even nobody's perfect, but try your very best to give the illusion of perfection when people are looking at your company. Things that kill value, and from an operational perspective, concentration risk of any kind. So if you've got only 3 clients and 1 left, and that was half of your revenue, that's going to materially change your cash flow and materially change the value of the business. And so purchasers don't like to see that, so you should be very much looking to diversify the number of clients, diversify the industries you deal with, diversify geographically, to add as many levels of diversification you can to the business, because that speaks to robust, predictable cash flow, and purchasers love that. That's the most valuable type of cash flow. Look for certifications that show people that you can do what you do in a consistent manner. Again, consistency is valuable. So ISO, HACCP, all those certifications that say that they don't necessarily say you're doing fantastic things, but whatever you're doing it consistently. So to a buyer that says, okay, I know they're not going to tick off their client base, and I know that their cash flow is likely to be consistent because of the way they're able to operate. Sales and marketing, and I know this is something that Entreflow works with people on, but for God's sake, make sure your sales and marketing are functioning at a high level. Particularly with some of the later stage companies we deal with, and earlier stage tech companies are usually pretty good at this, and they understand the value and they understand current sales and marketing techniques. Later stage companies, oftentimes they're comfortable. They've got a track record with a bunch of clients that they know very well, and there's little or no sales and marketing effort being made anymore. That's not attractive to a purchaser, because it's a very important functional area of the business that's been neglected. And B, if you can push on that gas pedal and do some sales and marketing and grow the business, it has a compounded effect on the value of the business. A company that's growing at 20, 30% a year is well more valuable, not just from EBITDA growth, but from multiple increase than a company that's flat. So make sure that you're really focused on that area. Corporate, so a lot of this is legal. Make sure you've got your contracts lined up. Everything's well documented. If you're dependent on a supplier or a key customer, make sure that's contracted. If you're in an industry where you can get multi-year contracts, that just speaks to predictability of revenue and cash flow, which again will enhance your value. If you have your procedures really well documented, that's very attractive to a purchaser. consider it an owner's manual for the business. So I'm coming in, I think I know the business, but I certainly don't know every nook and cranny of how it operates. And so if there's a really good documented process manual, that is going to make people feel a lot more comfortable about the transition risk they're taking on, and pay you more for the business. Always better if you're not being sued to infinity when you're going to market. So I would suggest settle anything like that. No businesses without some sort of legal things going on, but make sure that they're not significant and the big ones are wrapped up. If there's an identifiable corporate culture, that will oftentimes add value. So if people work for you for reasons other than just producing widgets, there's a higher mission. Makes it easier for you to recruit top talent, makes it easier for you to keep them, makes it easier for you to sell your products and services in the market. So that is something that you want to continue to nurture. And most of the time, awards and public profile is, I think, largely not valuable and maybe even a hindrance because you're telling your competition how well you're doing. But in the year or two prior to sell, purchasers like to see that kind of stuff. So if you're a Canada 50 Best Managed Company, or you've won the Entrepreneur of the Year award, or what have you, that is some nice window dressing to assist in selling business. And then number 5, and not 5th on the list, I think this is probably one of the very most important things, is have your financial house in order. Your reporting should be able to produce in-house results in a timely manner. They have to be accurate. You should be able to produce a whole bunch of sub-reports and breakout details, and you should be tracking a lot of important details. You should be producing a dashboard that speaks to the very important metrics that you are following when running your business, because purchasers are going to expect that to be in place. And we'll talk about diligence in a minute here, but it's a critical element in diligence. And if you're not on top of that, it's going to cost you a lot of money in terms of value. A, you're probably not going to get the interest of sophisticated buyers, and B, they're not going to pay top value because they're worried about what's really under the hood when the financial reporting is not good. You also want to do some cleanup things. If you own the property and you're renting it back to the operating company, you're not selling the property, you want to make sure that you're charging market rent, so that the income statement of the operating company is a fair representation of what market looks like. Don't be running all your personal expenses through the business for a year or two before selling, so that it's a nice clean presentation. We would of course back those out and normalize those if we're going to market, if there are those expenses. But every time you do that, you do lose a little bit of ground with the seller, and you oftentimes don't get the full adjustment. And so it's just cleaner to clean that out. And make sure you're operating effectively from a working capital perspective. Anytime you sell a business, it has to come with an appropriate amount of working capital. And so understanding what is appropriate and not running fat with too much working capital and more than you need is key. You want to demonstrate that you need very little or the absolute minimum working capital that you need to operate, and that's what will be left in when you sell the company. If you leave lots of working capital lying around and now you're making the case that, oh, we actually only need half that much for you to run the business, that's a difficult argument to make, and vendors are going to want to see more of that left in the business, and that's cash that you could have in your pocket otherwise. And for technology companies, this can be very meaningful. Like we sold a software as a service business that comfortably ran with negative working capital because they have a healthy deferred revenue balance. The money is not refundable when they get it in. And so this company can run with negative working capital in perpetuity. And you need to understand that and be able to present that to purchasers. Because if you're sitting with $1 million in net positive working capital, but the reality is you could run with minus 500,000, that's $1.5 million in cash that's being left in the deal that shouldn't be.
Very good.
So yeah, so those are some of the usual suspects. And then, as I say, you'll want to run a COVID thread through this and just explain how you've dealt with COVID in these various buckets, and hopefully you've dealt with it well, because that again will add value.
Mm-hmm. So I did my own personal reflection on some business health things. So to corroborate those things with just generally, even if you're not considering an exit, and it's impossible to boil this down into one slide, but I've done my best. And I noticed that a number of the things are the same thing. So on the HR side of things, what we're often focusing on is the fundamentals, right? So having a really strong plan, having the org chart in place, really clear on who's doing what and how their performance is measured. Having the strong talent on the team, like you mentioned, but also the ability to attract new talent. And do you have a process for that? Do you have that capability in-house? And what does your culture look like? So are people working for you, as you said, because they're aligned with your mission and vision, or is it purely because of a paycheck or something like that? So we really want to make sure that those things are in place. Operations, kind of what you were indicating there. We don't want too much focus on one or two clients. We really want to diversify, but focus on have some focus. You can't go after all markets. So definitely focus on 2 or 3 different applications of the solution that you might have. Make sure that you really understand the margins behind these things so you can make some good decisions. That really comes out of having up-to-date books. That really comes out of having, yes, here's how my business is doing, and I can pull this lever or that lever. And you can't do that if your books are not up to date. You can't do that if you don't have your dashboards in place that you can refer to. A lot of businesses, when they come to us, they're behind on their books by 2, 3, 4, 6 months even, or they haven't looked at their budget in 6 months. And how do you realistically run a business that way? You're not going to hit your goals if you don't set your goals. You're not going to hit your goals if you don't measure your progress towards your goals. And you're not going to hit your goals if you don't set your goals, measure progress, and understand how to change your path towards those goals. So these things are really, really super important, and that's why I put them on this slide. So it's nice to see that there's a really strong intersection between what I put down as my thoughts and what you had on your previous slide there. If we could draw a Venn diagram, it would be almost overlapping.
Yeah, exactly. And I'll add that, like, especially for earlier stage companies who are focused on a whole bunch of other things, it's oftentimes difficult to have the bandwidth to get all of this in place appropriately. Even for later stage companies that have been around for 20, 30, 40 years, we see them having a tough time actually executing on this. And that's why having a third party come in, develop the strategy, put the system in place, and then hold you accountable, I think is so valuable. So, what you're doing in Entreflow, I think is terrific.
Thanks, Axel. All right. So let's talk about what to do today. And look, we're running a little short on time, and there are some questions in the queue. So let's see if we can run through this quick, and then we can get to some more questions at the end. The due diligence piece. Yeah, when I saw this number, wow, yeah, there's a lot more to it than even I thought, and we've been through a few of these. Yes. So
yeah, so diligence is grueling. We're very clear with our clients up front that you're going to wish you didn't start this process at least 3 times along the way. And diligence is one of the times when people really get sick and tired of it. And we draw them back to the previous slide that shows that you can get 3 to 7 times in very diverse terms, and that's why you're kind of crawling through this cut glass to get this done. But this is an example, and you're targeting, the ideal is a large public strategic acquirer, because that's the best thing for value and terms. But the downside of that is they have very detailed, very professional diligence processes, because they're public companies, they're accountable to the shareholders. And so they have to show that they've looked under every rock before they've put shareholder money at risk in an acquisition. And so this is an example from recent transaction. This was the starting diligence list. And as you can appreciate, many of these items have multiple follow-on questions based on whatever is being provided. And so you need to have your act in order from a financial and operational perspective in order to be able to just step up and provide this information in a professional and accurate manner, because the death of a process is inaccurate information. Mm-hmm. People start getting a sense that chunks of the information are not accurate. Again, it's like the broken seat on an airplane. Like if they're not looking after the airplane seat, what else is not good in this plane, and do I want to be here? Mm-hmm. So it's a daunting process.
So I think the message here is be ready, always be ready. I think these things, most of them are required anyway for an effectively run business, is just how you keep them organized. And
oh, you're bang on. I think all the pre-sale preparation tips, that's a misnomer. Those aren't pre-sale tips. Those are running good business tips, really. And everybody kind of pre-packages them as pre-sale prep. But why would you not be running your business this way all the time? It's like you're selling your house. Why would you do a massive reno, make it lovely, live in it for a week, and then sell it to somebody else? Like, well, if you do all these things all the time, whether you're selling or not, you're going to have a fantastic, robust, profitable business that's going to be good for you.
For sure. Okay.
Yeah, so don't take it personally. Diligence is, 2 to 3 months usually of people calling your baby ugly, that which you've strained and worked really hard, oftentimes for a long time to make. They are picking at it to try and pull out the weaknesses so that they can pay less for your business. And so one of the reasons it's good to have an advisor is you've got that buffer in the middle that can deal with that and keep you from absolutely losing it when you're taking offense at what people are saying about the company that you've built. I touched on this earlier. You've got to be able to deliver the information in a timely manner. The saying in the industry is time kills deals, and it's absolutely accurate. The longer it takes to get through diligence, the less likely you are going to actually get through it. And so you need to be able to provide that information. A large public acquirer, they've got a lot of deals to look at, and time is one of their most valuable assets. And so if they think this thing's going to get bogged down, sayonara, you're out the door, and they're on to the next.
Okay. I'm rushing through because I want to get to the questions.
Yeah, no worries. And I've covered a lot of these things, so I'll just pick out a few. Challenges, considerations, one thing that people often ignore. Price is only one thing. It's oftentimes not the most important thing. How you get paid, how much cash you get at close is a very critical thing. I've talked about working capital, so I won't talk about that one again. And then reps, warranties, and indemnities. So the legal documentation, there are so many fine details in there that can have material impacts on how the deal actually, what the outcome looks like for you longer term. So having a very good M&A lawyer, like a specific M&A lawyer, is critical. A general lawyer is not going to understand all the details in terms and conditions of an M&A transaction, and so I highly recommend that people use an M&A lawyer when they're on these deals.
Okay, so we have some questions in the queue, and we'll bring them up in just a second. I'm putting our contact information up on the screen here, and I would encourage you to reach out if you have questions about this kind of topic that aren't covered today, or perhaps you're watching on the recording after the fact. Please, by all means, reach out by email is the best way to get a hold of me. Axel's got his information up on the slide there as well. And in just a minute here, I'm going to put my LinkedIn contact information up in the chat. So if you're following the chat, then you can connect with me directly on LinkedIn. I love adding connections and keeping up with people online, so please do that. Okay, so this is going back a little bit, and sorry we're a little out of sync. I was trying to get through most of the content. But we had a question about a specific industry, which was crypto companies. Those were really hot a short while ago, and then everything died. And it seemed like the companies that actually had something, not just the hype, survived and are carrying on. So I guess the question is, what's the status with that particular industry? Are you seeing M&A interest in cryptocurrencies?
So I think it's basically exactly as described. There was a lot of activity, call it a year and a half, 2 years ago. We saw numerous inquiries around M&A in crypto. That died off fairly significantly, but post-COVID, we're starting to see more and more interest in that area again. So I think there's certainly a resurgence in the crypto space.
Okay, very cool. So if you do run a cryptocurrency company, then maybe this is time to think again about some kind of exit or M&A activity or investment. But my guidance, at least, would be to really think of this in terms of the way that the markets traditionally work. I think many cryptocurrency companies tried to sort of do it their own way, and ended up getting into hot water around that. So think of it in terms of a normal M&A process, courting buyers in the normal way, and you'll probably have some success if there's something of substance there. Okay, the next question was around pre-revenue companies, and how should pre-revenue companies think about their valuation, and how they progress towards an eventual exit.
So we don't actually work with pre-revenue companies. So I think I would be talking a little bit out of school by talking about it. I mean, do some personal investing on the side, but I would call myself an armchair expert when it comes to pre-revenue. We do work with a few other firms that are more focused on that pre-revenue stage. And so what I would suggest is just reach out to me after the panel, and I can give you a few names of folks that are truly expert in that stage of company, and they can give you a much better, I think, view on where valuations are going there.
Yeah, very good. What I've done a couple of valuations on pre-revenue companies, and they're normally less focused on valuation multiples and more so thinking about how this company might grow, the total market potential, and to what extent can you predict that there will be free cash flows coming in from this. Generally speaking, these conversations are typically between two founders or something like that, versus a professional investor putting money in. Normally they'll use different instruments like convertible debt and safe notes and things like that if they want to put money into a pre-revenue company, so they can sort of kick the valuation can down the road for a few years. All the things that we've been talking about, though, for apply to pre-revenue companies when it comes to how to prepare and how to what sorts of things to get in place to be ready for an exit. You can start now, I think, is the message. And it's easier to start when you're in pre-revenue and a smaller company than it is to sort of wind back the clock and catch up on, say, a year and a half of bookkeeping or 8 years of tax filings. It's a good idea to keep on top of it from the start. Next question was about patents. So I suppose a large portion of what a buyer might be interested in buying is the intellectual property that a company owns, particularly with regards to technology companies. So can you comment on how that is factored into valuations and exits?
Yeah, and there's oftentimes a couple of views on patents. Some say, okay, why am I going to get a patent, disclose all my secrets to all my competitors who think they can use that information, therefore I don't get a patent. And others are like, oh, well, I've developed this technology, I've got to lock it up and protect myself. And so I think both of those have validity to some extent. My view is in situations where you're developing something that's, it's unique, but it's not high tech. Maybe you want to keep that a trade secret and not patent it, because it's not so complex that your competition is not going to be able to change it just a little bit and get around the patent and be competing with you. Where you've put thousands of hours in development and you've got this algorithm that's incredibly complex and probably would be difficult to copy in any case, I think there's obviously tremendous value in patenting that, and that will add value to your company, because anybody that's purchasing the business can potentially leverage that technology advantage over a much broader client base and generate more cash flow from that patent protection, and ensure that that cash flow goes to them and not to all the competitors in the space. A good example of that recently with tech company Vigilon, a digital surveillance camera business, had all sorts of algorithms around compressing the digital images, video that they were collecting, and compressing and storing it. And they patented all of that. They went further to buy a patent library in the digital camera surveillance space that really gave them a bit of a stranglehold over other competitors, because these were patents that many of their competitors were having to use. And now they were licensing these patents to their competition. And as those agreements came up, they really had a strong competitive advantage. So I think if you've got real strong technology, patents are essential and do create material value.
Very good. We are at time, so I think what remains to be said is thank you. Thank you, Axel, for joining us today and sharing your insight and knowledge into this very important area for owners and founders to consider. And thanks to everyone who showed up and asked wonderful, valuable questions. I'm going to make the recording available online afterwards. I've put the link to sign up for the series in the chat. So if you haven't already signed up for the series, please do, and you'll get notifications about the next one coming up. So again, thank you very much, everyone, and I hope you enjoy the rest of your day.
All right, thanks, Ian. Okay, thanks, everyone.